A webinar on the subject of the repatriation tax and GILTI and their impact on Americans living abroad who have interests in CFCs. I know that the bulk of you are either tax professionals, I just saw that by the domains, and or people that have are themselves expats who have interest in CFCs and are impacted by the repatriation tax. I'm going to try to aim high today, not to the lowest common denominator, but to try to provide true value to the people. And I will assume that some of you have knowledge of this matter. So again, I want it to be worth your while. And we will try to aim high and cover issues. This seminar will focus on the repatriation tax because of the timeliness of the matter in terms of filings, in terms of the first payments that are due by June 15th. GILTI is definitely a matter of concern, but we will touch upon it if we have time briefly. But I want to put the repatriation tax first. Also, that is where the developments which I want to talk about it just happened, and so I think that that is where we will focus the bulk of the time. Anyways, the agenda for today is a brief personal introduction. We will then talk about an overview of the U.S. law and CFC and the repatriation tax, the law. Then we will get into numbers, understanding how the computations are made, filing obligations, payment obligations, and then alternative action points. Meaning one is compliance, one is planning around the tax, and the third one is the tax advocacy. I know most of you, all of you, are business people, professionals, and the issue of tax advocacy is a bit foreign to you. But if you look at the surprise on the right, the surprise will be disclosed at the end of the webinar, and it is a direct result of tax advocacy. It's not the result of you and me sitting in our office doing, representing clients. So it's very important to discuss the tax advocacy, because that is where change is possible, has occurred, and when we move ahead into the next levels, which are the legislative fix, it becomes even more important. Okay? So this is the agenda for today. My name is Monte Silver. I'm a U.S. tax attorney residing in Israel. Several of the people on this web seminar, the audience, know me. I got my education at UCLA undergrad, Boston University Law School, worked for 2 years in the estate and gift tax division of the IRS, and then a year at the U.S. Tax Court. And worked in the private practice for a couple of years before moving back to Israel 17 years ago. I do one thing and one thing only. That is, I practice U.S. tax and represent many, many people around the world, not Americans living in America, but American expats and people who are investing, who are not Americans, who invest in the United States. That's what I do, and only that. And I come up with creative solutions to solve lots of tough problems. That is myself. And now we will go into the actual presentation about the U.S. law. Okay, the fundamentals, we'll start with the fundamentals. I will go over this relatively quickly. Okay, so the first is, how do I even get involved in this whole issue? Okay, the tax reform passed in June, in end of December. January 15th, a guy comes to me, an Israeli, an attorney, like myself, attorney, American. I own a corporation, 100% of that corporation. It's a small business. He comes to me January 15th and says, I think I may have a problem. He doesn't know what that problem is, but he says, I think I have a problem. Someone said I should look at the tax reform. So I did, and I spent a few days at it, and I could see that him, like I, may be subject to the repatriation tax. So it's simple CFC, the repatriation tax is a simple CFC law, and all my earnings and profits for 30 years are going to be now taxed just like Google's and Apple's. So I call up Baker McKenzie, who I deal a lot with, and I ask him if this is possible. And they answer back, we have no idea. And I say, well, what do you mean you have no idea? I mean, you guys, you're Baker McKenzie. So they say to me, we represent Google's and Apple's. We don't really care about Montes of the world. And then I realized that I had a major issue here. So I went to the Financial Times, they published it. And from that day on, kind of my life changed. That article in Financial Times, which was on February 5th, put me in touch with hundreds and hundreds of expats around the world, all with the same problem, or not knowing what their problem even was, but that started an avalanche. And as a result, two things happened. Number one, I started publishing a heck of a lot in top tax journals, and also in Germany, the UK, in Israel extensively, seminars throughout Europe and Israel. So that really, number one, brought me, made me realize that GILTI and repatriation tax are devastating for us expats. And number two, I realized very early on that if we wanted to win this patently unfair issue, that we would have to get into tax advocacy. So this was launched, this petition, on March 3rd, less than 3 months ago. And within weeks, I was in Washington, D.C., meeting the people, because this it turns out that the Democrats abroad, Republicans overseas, AARO, ACA, you see on the bottom, quickly adopted this petition. And without me knowing it, the people who were receiving it from the Ways and Means Committee, the people who were on the receiving end of this, from the Finance Committee, the Treasury, and the Ways and Means, they were being inundated with 50 emails a day, and they were very eager to learn what the problem was. So now I'm in touch with all these organizations in Congress and demanding fixes, realizing that the fixes were not going to come from the legislation, not quick enough to absolve us of the first payments under this tax, but we would have to focus on Treasury. And that began, then we got the first fix about 2 months ago, extending the first payment. And I will discuss this in more detail, but just so you know a little bit about their tax advocacy. And I want to reiterate, some of you are saying, why is he talking about this? I'm a tax person, so am I. What do I have to do? What do I care about this? Okay, so you see that little surprise box on the side? You care about that, believe me. And that is a result of tax advocacy and what I'll announce later on. Okay, so without this, you and me are on the hook, and there's nothing we can do about it. Okay, the only way to change this is by tax advocacy. So we got the first win in early March, which extended the debt times to pay their first payment until June 15th. And then you have that surprise on the bottom, which we'll talk about the second fix. So this is what happened, and it's put me in touch with, again, endless stories and endless people. This is, good, really sad stories many times, but unfair stories, and everybody agrees, even in Congress, and that's why we're able to make some headway. Okay, so now we'll go into the, into this tax, and I, again, will try to make this as deep as possible to shoot high, and rather than to aim low. Okay, so we all know the basics, that a U.S. company or a citizen or a resident pays tax on U.S. income worldwide, and non-U.S. persons residing abroad don't pay any tax in the United States unless it's U.S. source income. Okay, That's the general rule. So if I'm an American, which I am, I pay Monte. I'm an American. I pay taxes worldwide. The person next to me, who's an Israeli in this case, does not pay any tax unless it's U.S. sourced income. Okay? And that's in the Israeli-American treaty. That's what it says, that the resident, individual, or corporate of Israel will be taxed by United States only on income from within the United States. Okay? We all have the same treaties. But there is, of course, the savings clause that, notwithstanding the treaty, America can tax Monte even if I'm a resident of Israel, and as if this treaty doesn't apply. Okay? But one thing is clear from this, that an Israeli corporation, which is not an American citizen, is not subject to tax on income from outside the United States, because my corporation is not an American. I'm an American. My corporation is not. Therefore, as long as my corporation doesn't have U.S. source income, it's not subject to tax. But we all know that is not true, because in 1962, the Americans saw that American companies were using foreign subsidiaries to store tax abroad. And it was the IBMs back then, and what they saw was IBM America was creating, let's say, a subsidiary in IBM in Ireland, IBM Ireland, but it wasn't Ireland back at the time. I don't know what jurisdictions it was, and they were building a computer, if that's what they sold, IBM, in the U.S. It cost $100. They would sell it to IBM Ireland for $101. And then IBM Ireland would sell it to other places in the world for $200. So IBM Ireland was making all the money, and America was getting shafted and only willing to able to tax $1 of the profit. Okay, that was the scenario that we saw. So what America did was that they created the CFC regime in 1962. They said that if there is a foreign corporation which is owned at least 50% by U.S. persons, and in this case, IBM owned 100% of the subsidiaries in Ireland and around the world, then until 2017, we're talking about the world until the recent reform, that if that corporation had bad income, subpart F income, we'll call it bad income just to make it simple. I didn't invent that term, but it is called bad income. So then if it has bad income, then each U.S. shareholder, meaning a person who owns at least 10%, has to pay its share of the bad income. Okay? So that was the situation until 2017. And that was, again, a circumvention of the treaty, that here you have a Irish or Israeli corporation owned by a parent in America, that if that Israeli corporation had bad income, it would be taxed in America. So it was a circumvention of the treaty, and the way the Americans got around it. They said, no, we're not taxing the Israeli corporation, we're taxing the U.S. shareholder, the individual. So they were as if looking at that Israeli or Irish corporation up until 2017 says, we pierce the veil of this corporation. It's not there. We're taxing the shareholders. And no one, I don't know if it was ever challenged by court, but that's what they did. And that went on until 2017, and without much of a holler, because very few people have this subpart of bad income. What is this bad income? You'll see, it's basically transactions based, where there's related parties, an IBM America, an IBM Israel, and these companies were related, and they were finagling their way out of paying taxes. They were using transfer pricing, all kinds of strange techniques. But me and you, we don't have that kind of income. We're not related parties. We don't have subsidiaries around the world. We're not buying and selling and trying to manipulate profits from one country to the next. We didn't have that. So subpart F was very limited, predominantly 99% to major corporations, not to you and me. There was one small case where subpart F was relevant to you and me, and that was for passive income, meaning if my Israeli corporation had passive income, then that would be subpart F, bad income, and I as a shareholder would have to pay a tax on that individually. So that did exist, but it was rarely used because there's de minimis rules and it's not something that happened. We see it, but not very often. And this really was something that did not affect us all that much. Okay, and then comes along Congress last year, and they say, wait, we have $2.4 trillion in subpart F income. In these companies, Microsoft, Apple, Google, holding $2.4 trillion bucks. We want to cut taxes, but we have to bring in this money somehow. We need revenue. Not only do we want the revenue, but we want these companies to bring this money into America and invest, make America great again. So the problem was that this was not subpart F income. This was not Google buying and selling components. This was, what they did here was they plunked patents, all their patents in Ireland, which tax is very low, and they would then enter into licensing agreements between Ireland and the United States, basically drawing huge amounts of money into Ireland. But this is not subpart F income, so there's no way to bring it back under subpart F. So what did they do? They amended subpart F in the reform and included two components. One of them is GILTI, which we're not going to talk about right now, we'll later. And number two is the repatriation tax. So what they did was basically they say, we're going to allow a one-time, we will have a one-time inclusion. All accumulated profits of that subsidiary from Google and Apple, that's what the focus was on, we will include in subpart F income one time only all profits of that corporation, that foreign corporation, for 30 years. One time inclusion, okay? The problem was that this was not limited to corporate shareholders like Google with their subsidiary. This was the way the wording was, is it will apply to individual US shareholders as well. So the result is that every US shareholder, corporate or individual, of a CFC must include all its shares of accumulated profit in its income. The implication is very clear, that if I am a US citizen or a green card holder anywhere in the world, and I own at least 10% of a foreign corporation, where 50% of that corporation is owned by Americans, then I pay the repatriation tax, okay? And so Monte and many of you, were you American corporations, I own a corporation 100%, so I meet the 10% and the 50%, so I'm on the hook for repatriation tax, with one catch, a nice little catch, that I don't pay the 15.5% that Google pays on cash, or the 8% on non-cash. I pay up to 17.54% tax on cash and 9.05% on non-cash. Worse than Google, okay? We will get into how that's calculated in a minute, but the bottom line is this, that I'm on the hook, just like every expat who has an interest in the CFC, who's a US shareholder with an interest in the CFC, I'm on the hook for the repatriation tax as it was drafted. Clearly not the target, not the intent. I know that because I went to Congress, the Ways and Means, and I was told that it wasn't the intent. So, and experts who've testified in the Senate hearings on the subject, I have emails from them verbatim saying this was ill prepared, it was rushed through, this was not the intent. Okay, mistake made, but now go fix the mistake. Okay? Okay, so now, so if I'm on the hook, we'll use a numerical example. So Monte's on the hook for I have, let's say, $1 million earnings and profit. Okay, I want to hearsay. I don't. Actually, I have zero earnings and profit. I'm not, Israel luckily last year had this very nice law where they said distribute dividends out of your corporation this year and you'll get much lower tax. So many of us did it. So I personally am not on the hook for this repatriation tax. That is not what's motivating me being on the hook. I'm not on the hook. But let's say I had $1 million and I'm subject to repatriation tax. I would pay $175,000 in the repatriation tax if everything is held in cash, or $90,000 if it was a non-cash. Okay, so here is how on the left you'll see how it's supposed to be paid, this $175,000, how Monte would pay it. And on the right, you see how the calculation is that I pay more than Google. So we'll start on the right. So the reason I pay more than Google is because the highest tax rate in 2017 for individuals was 39.6, and for Google it was only 35. So that's a 13% higher rate that I pay over Google. So if I have $1 million which I have to include, I'm going to be in the highest rate, tax rate for individuals. So I will pay 13% more than 15.5. I will pay 17.54 on the cash and 9.05% on the non-cash component. Again, the reasoning is that the individual rates were higher than the corporate rates, and that is what I'm going to pay. Higher than Google. I repeat, higher than Google. Okay. Now, how am I supposed to pay this $175,000? There's a payment plan. If I elect to use the payment plan, I can spread the $175,000 in 8-year installments, not equal. The first 5 years are 8% each year. So the first year I can pay 8% of the $175,000, which is about 8% of 100, let's say $15,000, a bit less. And that's the same for every year of the first 5, and then 15% of the 175,000, and so on until the 8th year. Okay, I can only make a payment plan like that if I elect. We will get into the election in a second, how you elect to do that. Because if you don't elect, you have to pay $175,000 up front. Okay, so obviously we all want to elect. Okay, again, I'm saying this without the surprise at the end. Okay, so the thing is this, that as under the law, the first installment was to be paid on April 15th, not June 15th. Under the law, which we'll see in a second, the first payment was April 15th. No expats in the world even knew about this stuff on April 15th. But nonetheless, if you did not pay the first payment or any future payment on the 15th of that month, of that year, then all payments become due immediately. Meaning, if Monte did not pay the 8% or $15,000 on April 15th, everything would be due immediately with penalties. Okay? That's the way, that's the situation that it was when the petition started, and it was clear that the expats are truly unprepared for this. We got a delay. The first fix we got from the Treasury, as I said, was a 2-month delay till June 15th. So as we speak about right now, if the first payment is not made on June 15th, then the entire $175,000 is due immediately without the ability to make payments. Okay, pretty bad. Now why is it also? It's not only that we're paying more than Google, but also we don't have the tax people that Google has. Google and Apple knew about this, that this was going to be an option, this repatriation tax, for years, and they've been planning for it. You and I, this came as a complete surprise. The first article in Financial Times came out February 5th. So that was the first time anybody ever knew about it. And I just got back from a tour in Europe lecturing on this. People are still clueless, and as I'm sure many of you are. So, or the tax professionals are. They don't understand this 30-page law. It's very long and it's highly complicated. So even if we wanted to comply, we couldn't comply. And I've seen that across Europe, and I'm sure the situation is even worse in lesser developed countries, as compared to Germany, France, and England. Okay, so this is hyper prejudicial. Okay, so here is what, now we get into the actual requirements. This is not the law. The law can be found by just Googling Internal Revenue Code section 965. That's the law. These are guidances that the IRS issued. Since the law came out and there's no regulations, the law is very vague and no one knows what to do. For example, okay, so they issued guidances. Now, each one of those guidances was 40 pages, 60 pages of very intricate tax stuff. So I took it upon myself to really shorten the core issues to simplify it for people around the world. And this slide I've sent to many people around the world just so they can understand what the obligations are. Okay, so here we have, and I've circled the key components of what the IRS guidance says. And you will see that this is 2 slides. The first slide here deals with how you actually report it, not how you pay it. Okay, the payment is on the second page. All this slide tells you how to actually report your repatriation tax. Okay, as you see in question Q3, how you report it. So on A3, answer 3, this is actually what is supposed to be included in the tax return. Okay, it is a statement that sets forth all those issues that have to be reported in a statement that is attached to the tax return. Okay, when is the tax return due? As it is always due. If you have, if you're living abroad, you have till June 15th. If you filed an extension, you have until October 15th. As we will get into later, it is extremely important that you file an extension today before June 15th. Okay, we'll talk about that in a moment. Okay, so the statement of compliance is included in the tax return. The tax return, of course, will include all the subpart F and the repatriation tax issues. Now, as I said, when must the election to spread it into 8 payments be made? The extension must be made with the filing of the return, meaning June 15th or April or October, which is why, and then the next one is how is it made? Okay, so there you have how the election is made and when it is made. And it is due, this election, June 15th, if you have not filed an election for the tax return to be filed. So I would recommend highly that first of all, you file an extension till October, so you have until then to make the payments, make the filings in the elections, okay? This has to do with the reporting. It does not have to do with the payments, okay? So this has to do with the payment. As you see, question 10, how should a taxpayer pay the tax? Okay, and here it says the payments must be paid by the due date without extension. Based on the clear wording of the law, that meant April 15th. Without extensions, the 2-month extension from April 15th to June 15th, that's an extension. And it was clear that the payment for expats had to be made by April 15th, but we got that extended, okay? But now we're facing a situation where we have until June 15th to make the first payment, okay? Very troubling because number one, our clients and we, not me again, I don't have earnings and profits, but we have to make that payment by June 15th. And if we don't, all the acceleration, if I don't make that $12,000, $15,000 payment, I owe everything on June 16th, all the $175,000. Now, do I know how much? Does my CPA know exactly how to calculate that? No. Does yours? No. It is hyper, we'll get into the calculations in a minute. You'll see it is hyper complex. It's very complex. So even if you wanted to, chances are you couldn't even figure out how much to pay. Okay? So June 15th is, without the surprise at the end, is when, is when we need to file the first payment, and the election is either June 15th or October 15th, submitted with the ordinary return. I would again advise all of you, and again, nothing herein is legal knowledge, is legal advice. I am just giving the high-level analysis of the law. But if you look at, okay, having said that, I repeat that nothing herein is legal advice, and you may not rely on anything I say as legal advice. But having said that, let's continue. Can you file an extension today for the extra 4 months? And it says here, this is right out of publication 54, you have to request the additional 4 months by the new date allowed by the 2-month extension. The way I read it, you have until June 15th to make sure you file a request for the next 4 months. Okay, so I would seriously do that to give you time to file the election and to prepare all the statements. Okay, now let's go to the numbers. I see so far that there's not a lot of questions. I'm very happy that everything is clear. Okay, so Monte, how am I going to calculate my total 965 tax and the first payment? And here, again, nothing here is legal advice. And these examples which I'm going to give are, as you see the asterisk below, it is the most simple example. It assumes one person, one shareholder, one corporation that has no subpart F income, that has not paid U.S. tax on any part of what's inside that corporation already. There's no business that that corporation is doing in America. This is a very simple solution, not multiple CFCs, one CFC, Monte CFC operating in Germany, wherever I live, we'll say in Israel, no subpart F income other than repatriation tax, okay? And this solution is what is set forth in the law. So you start with earnings and profit of $1 million. That's what I said I have. And let's say $800,000 of that is cash or cash equivalent. It's cash or stocks and bonds. And then I have another $200,000 in real estate. I want to build a little plant. I want to expand my little business, or I bought an office. And that's where my business is, okay? I bought an office with some of my earnings and profit, and that's $200,000. So the $1 million is made out of 800,000 and 200,000. Excuse me. Okay, so we'll start with the $800,000. I am allowed, in order to bring me, I'm allowed a deduction, everybody's allowed a deduction of 55.7% from that amount. And so the deduction is $445,600. And then the net amount I have to pay tax on is $354,400. My tax rate for such high income will be, my marginal rate will be 39.6. So I pay on the tax component $140,342. Okay, that's just remember these numbers, the deduction of 445 and the total cash I pay of 140. Okay, that's on the cash component. On the non-cash component, 200,000, I get a deduction of 77.1%. So the deduction is 154. I'm left with 45,800. I'm taxed on that at my marginal rate of 39.6, and the tax on the non-cash component is 18,000. Okay. So this has brought me to a total tax of 140 plus 18, $158,000 conceptually. I have to pay Uncle Sam. That's stage one. Okay. Now the calculation goes to using foreign. Now that we know how much I have to pay for each component for the cash and non-cash, let's see if I have foreign tax credits. If I have foreign tax credits to use, I can use them. Okay. Okay, so now let's say that I, Monte, had $100,000 in taxes I paid in Israel that I have never used to offset U.S. income in my tax return. So I have $100,000 foreign tax credit, again, taxes I've paid in Israel that I've never used in America. Okay, so the total deductions I got up until now was $154,000 on the cash and $445,600. Those were the deductions I took. That's a total of $600,000. So basically, I'm only being taxed on 40% on the remainder of $1 million minus $600,000 at 40%. So I can only use 40% of my tax credit to offset the tax. So I'm really only allowed not 100,000, but only 40,000. Okay. I had my total income. Let's say I had no income in 2017. I had nothing. I didn't work. I was sitting on the beach all day. My only income is the repatriation tax income. Okay. Another simplification. I had no other income. So we'll say that my only income is what I have to pay tax on, which is the total amount of the gain of the repatriation income minus the deduction is 400,000. That's it. Okay. I have to add that to the $40,000 I get in tax credits. So now I have taxable income of 440,000. I go to the tax tables after taking out standard deductions and exemptions, and I have to pay $130,000 in tax minus $40,000 in the credit. I have to pay my total tax to pay is $90,000, of which 8% is due this year. Okay, so there you have a very complicated calculation as to how I figure out what my tax is under the repatriation tax. Extremely, extremely difficult. And I know that if I had a bunch of people, CPAs, who could chat right now, they'd be asking me 100 very poignant questions, and they'd probably be finding holes in this. This is, okay, this is basically, you know, a rough idea of how it's calculated. It's pretty accurate, but nonetheless, highly, highly complicated. Okay? Okay. So that being, 1 second, I'm just looking at a few comments here. Okay, so what we can, I see Joan, you've asked, excuse me, Caroline, maybe this will answer your question when we get into 962 elections. So the way to avoid this tax, other than the surprise at the end, I'm building up that surprise, and I think, so the question is, do you not take into account corporate taxes? No, you don't. And for the very clear reason is because I am personally, Monte is personally considered as having to pay this tax. Okay? Monte could not take credits for the corporation. Monte is being taxed on the repatriation tax. The shareholder is liable. Here, for me, the shareholder is Monte. So I cannot go to IRS and say, I want to take both personal credits and tax credits for the corporation. I am not allowed to take the credits for what the corporation paid. Only a corporation can take. There's provisions for allowing foreign tax credit, only for corporate shareholders. So I cannot. Okay, so how do we get around this? And I will try to speed up now because I think the time is pressing. Actually, yeah, okay. So the first way is to find ways to prevent the company from being a CFC and even being subject to the repatriation tax. Now, obviously the problem is that the cutoff date for determining this was December 31st, 2017. Any changes made after that are not going to work for repatriation tax. But what is there? What could possibly work in that case? Who are or could be considered to be owners of the CFC by operation of law, agreements of parties, gifts or gifts that occurred. So if there are ways, and I'm not going to get into this now, if there are ways to find by operation of law that, or by agreement, that this actual corporation was not owned 50% by U.S. shareholders, then that is a way you can work around it. I'll just throw out an idea: community property states. Okay, but I'm not going to get into that much. Another way to look at this is, don't go, what would the numerical example I gave assumes that we first take the repatriation tax, deduct the deductions, and then take the foreign tax credit. But maybe it's better not to take that deduction and just go straightly for foreign tax credits of Monte. If I have a lot of them, maybe it's better for me to just forget those deductions, which are not dollar per dollar, but the credit is dollar per dollar. Okay, so those that's another way. And the last one, which goes to Caroline's or Ed's question regarding taking credits for corporations. And this goes to the 962 election. The 962 election basically says that Monte, if I want to treat myself as a corporation, I can make the 962 election and be considered as an individual. I'm a corporation only for CFC purposes, only for controlled subpart F, for subpart F income, not for any other purpose. But I can be considered to be a corporation. Okay, and now when is that beneficial? Obviously, if I have no personal foreign tax credit, but the corporation has paid in its country tons of taxes, and it may have a lot of tax credits, that if I were a corporation, then I could use those since I'm the parent corporation. Okay, so you elect for a yearly basis to be treated as a corporation, and then you can take those credits. Now, so when is that beneficial? Obviously, as I said, when the corporation has lots of foreign tax credits and much more than the personal that's available. And many times that's in certain countries. I have this guy who came in from somewhere in Latin America. He's never taken any salaries because he's growing his business, and he never took any salaries. And yet the corporation paid taxes over the years, and there's a lot of foreign tax, corporate taxes there. Okay, so there it may make sense, but there's a very significant issue. And again, nothing I say here is legal advice. I'm doing this as a service because I want to help. But if you do that, there's a huge problem. Okay, let's say I select for 2017 to be treated as a corporation, and then 2018, 19, 20, I distribute money from that $1 million that I have in there. Okay, under this election that I've made, 962D, every dollar I take out of that corporation as dividends is subject to tax. And if I'm a high-paying individual tax rater, that's 37%. Okay? If I did not make the 962 election, there is zero tax in America under 959A1 on the money I take out. So a big question is, are you going to be taking out money from that corporation? How much is the local tax in that? How much are you going to pay locally on that distribution? Is there going to be offsets? This is a very, very serious thing to take into consideration if you're going to be considering 962, is this post-2017 distribution, which is all subject to tax. And if it's a lot of money, then that's high taxes in America, and otherwise there would not be taxes. Okay, I want to save money for the surprise. We're not going to get into GILTI, we just don't have the time. What I will do is conclusions, very bad wake-up call, generally accepted to be unfair. Options, there are solutions, as I'm pointing out, but don't forget that June 15th deadline and the reporting deadline, and then tax advocacy. So I now return to the tax advocacy because this is the surprise. And it's okay, so what is the surprise? I'm sure there's a lot of people very eager. So the surprise will be announced formally today or tomorrow. Yes, Thursday or Friday. The Treasury, and nothing I say herein should be treated as reality until it's made public in the next day or two. It can be today, it can be tomorrow. It's basically been approved, but until it's published, do not rely on it, okay? But the Treasury has agreed to the following, that taxpayers living abroad who have less than a certain amount of tax liability under the repatriation law will not be subject to the acceleration and will not be subject to negligence and other penalties for not making the first annual payment. Okay? Nothing I say is final until it's published. Okay? Nothing I say is final until it's published today or tomorrow. The Treasury, with all expectations, will release in the next very short time a statement which says that for taxpayers below a certain threshold, there will be no acceleration and no negligence or any other penalties for failure to pay the repatriation tax the first year. Okay, so that gives us 1 year to get a legislative fix to change this law. What it means is if there's no penalty really for not making the payment, why make it? Okay, that's the best I could get from the Treasury, because they cannot change the law, but they could find a way to kind of work on to sort of fudge the enforcement of it. So that is what they've agreed to. I will not say what that threshold is. I will have another web seminar within a week once it goes public to explain the ins and outs of it. But there you have it. You can assume that small business owners fall within the threshold and will be gaining from the release. And again, if it goes public, it's within the next, should be today, should be tomorrow at latest. Check on my website, on the blog, you will see it. I will, if it goes public and when it goes public, I will send you emails of it. So all the people that have signed up for the webinar today will receive it. So you will know that it's public. We will have another webinar in a week to discuss before the June 15th deadline what it means and what should be done. But that is what can be done with tax advocacy, okay? I couldn't have done this sitting in my office. Okay, I'm a good tax attorney, very good tax attorney. I am. And I'm not doing this for business. I've spent much more money on this, and I've told a lot of people who are willing to give me money, I don't want the money, I'm gonna fix this for free. I'm not a Mother Teresa, I have a good business, I could afford to do it. But tax advocacy is what's helped me help you, okay? And the next stage, once this goes public, is to fix this legislatively. And I want each one of you, okay? You will receive a petition from me to do what has to be done to win this legislative fix. I want each one of you, and this is the demand. You will receive that petition and you will take action, because this is what will give us the permanent solution to this. A complete exemption always for expats, okay? So I'm doing this, not Mother Teresa, it's the right thing to do. I enjoy doing this, and I'm not exposed to this tax at all. I am not. And I'm losing money by doing this, but I'm happy to do it. But I want each one of you, when you get the next petition, to lobby your congressperson. It'll be very simple. Cut, paste, okay? I'll make it very simple for you. But if we want to win this, and we've won 2 battles in 3 months without spending a dime. I've spent $20,000 of my own money, okay? I have. You have not spent a dime. I'm not asking for a dime. I want you to take active, to send an email, to register to vote. These are the things which will win us the battle, okay? It's not even registering to vote. It's sending the petitions that I will prepare, click, cut, paste, send, making a phone call, okay? And I'm very passionate about this because I've seen what we can do, okay? And this, you will see this within 24 hours or even today, okay? So that's what can be done. And I'm happy to help pro bono. If you have clients that fall under the fix, I will make myself available to answer questions, and I will not take a dime for it, okay? For expats that fall under the exemption or the fix that I've created, the dollar limit will be set forth shortly in the fix. I will answer questions. I will answer your emails. I will not take a dime for that, okay? There you have it. If you have clients who don't fall within the exemption, that's another story. Then they are really on the hook, and they have until June 15th to file that extension and to make that first payment. They must make that payment by, if they don't fall within the exception, by June 15th or suffer the acceleration. There are solutions. I have solutions. I can help. It will not necessarily be for free, but for people who fall within the exception, I'm available. I'll have another web seminar. And again, I want you to do your share in fighting to win this battle, because we will win it, okay? There's a few last questions. How do you get copies of the slides? I'll send it out after it's been sanitized to remove any potential liability on my side for giving legal advice. Is foreign tax actual? It has to be paid. If you didn't pay the tax by December 31st, or excuse me, taxes for December 31st, then yeah, it has to be paid for the tax year of December 31st. You cannot draw a dividend, at least the way I read the law, in 2018 and then seek credit for what was paid for tax year 2018, because the liability was set December 31st, 2017, and I don't think that 1 year carryback of Section 901 applies. You cannot carry back. Okay, I believe that answers all the questions, and it is now 3 minutes to 1. I'm here for 3 more minutes, available for a call for any questions. Let's see. Wow, quite a lot of you have stayed till the very end. Here's a question from Joan. If a corporation has never paid U.S. tax, does it have? Yeah, usually okay. So my corporation has never paid tax in Israel. It doesn't have to. I never, up until the repatriation tax, I never had. So I've paid taxes in my corporation is to pay taxes in Israel, and I've never sought foreign tax credits. So yes. So so yes, everything my corporation has paid, but I have to do that 962 election to allow me to get them, because I cannot use them if I'm not a corporation. Only a corporation can use those tax credits. Okay, you're asking me, Jared, what is the personnel of the IRS? Everybody says it was a mistake. I honestly, I've met with them from the highest people up, all down to the experts. It was all a mistake. Everybody knows it was a mistake. The question is, can we win? This is our second win. Don't forget that. We've won 2 fixes. Okay, we have 1 more fix to go. We can win it. And if people know me, and I'm a bulldozer, and I'm not going, I build alliances. You have to build alliances. We will win this. We'll do it. Okay. Am I going to do another one on GILTI? I don't know. Not yet. The next webinar I do, it will be done on the fix and what it. Okay. Then there's a question here. Are we talking passive or active? That's already getting into legal advice, and I just don't want to get into. That's a very important question, whether it's a tax, for tax purposes, we're talking active or passive or general basket. If you want to email me that, I don't feel comfortable answering that in front of so many people. The GILTI applies from 2018. If a business, Suri asks this, if a business has some of its money in the U.S., is that counted? Of course it's counted. If what's counted is the accumulated profits. It doesn't matter where you hold that money. It's the accumulated profits. Can you make the 962 election in 2017 and then gift the shares? No, you don't want to do that. That's too complicated. I don't want to answer that on the spur of the moment. That was a question by Caroline. I have 1 minute to go. If I now, Eli, if I make the election under 962 and years later take dividends and pay the tax in the foreign company, can I use a foreign tax credit? In the year in question, yes. Now the question is, if you make that, is that going to be considered, or when you take the dividend, is that going to be considered? How's that going to be classified? There's a tax court case, Smith versus the commissioner, on that question, Eli. So I think, in general, yes, you should be allowed, if you take the tax. If you pay tax in Israel, when you take that dividend 5 years from now, you pay tax in Israel, yes, you will be able to you should be able to get a foreign tax credit against what you pay in America. But those are, the whole 962 must be taken with extreme caution. Very, very, very extreme caution should be used. It's never been used, rarely been used. So make sure you're doing the right thing if you use it. Okay, I think now it's 1:03. I will